Hello, everybody, and welcome to the Liker Totas channel. So happy to have you join us once again. I was actually missing creating videos on companies. It's been a few days because I've been so heavily focused on putting everything together, on our in our Skool community and the new features. And so I was busy with the relaunch. Unfortunately, already a lot of people have joined, and they continue to join. And if you are one of them, then please, just consider joining and providing feedback. It's free, right? You're going to have paying features, but you can also have the standard a plan, which is entirely free, and you can still gain value from it. Of course, that is always the goal. And at the end of the day, I just want to create more value for you guys. So if you are happy, I'm happy, and it should happen like that, right? Okay, guys. So today's video is going to be on Meta and whether I think this company is a good investment at the current price. I think the stock is down about 80-90% from its all-time high, reached not that long ago. And this was, so I decided to create this video. Some of you have already told me to talk about this company in Max 7. That's why I created past videos on Amazon. No, not on Amazon, sorry, but certainly on Microsoft, and I think there was another one probably, but certainly on Microsoft. And right now I want to address a comment that was put out by Stanislav, and he told me to. Sorry if I'm mispronouncing your name, by the way, but yeah, you told me to do a video on Meta more recently, and that's exactly what I intend to do. Okay. And as always, thank you if you have been following the channel for a while. Thank you so much. I continue to read your feedback. That is awesome. It makes my day in weeks. And if you are new to the channel, welcome. And hopefully you will gain a ton of value from all this free content that we are putting out. You can see, as always, I know that many of you watching this video are now Portuguese because you have you started following me right after the podcast that I did with Dividendos Portugal. It was a great experience, and thank you for all the great feedback. Right, so let's talk business, everyone. Meta, do I think this company is a good investment or at today's prices, or do I think you should stay away? You should run. Right. As always, there is only so much that I can cover in these videos. I can make this into a 2-hour long video, like similar to what I did with Constellation, right? Where I just provided a full deep dive into the company, touching management, valuation, the end market, competition, industry, and so on and forth. But for most of these videos, for simplicity's sake, of course, I will just cover the fundamentals from a financial standpoint. All right. Now, look. Yes, many of the Max 7, if not all of them, well, certainly not all of them, but most of them have phenomenal financials. Right now, because of the investments into AI, right, GPUs, data centers, CapEx has been going up, returns on capital have been going down, and we don't really know how much of these investments will actually yield profits down the line. And that, ladies and gentlemen, is part of the reason why many of these companies are now off their recent highs, all right? Is Meta one of them? We all know Meta, former Facebook, right? It's a company that has been on my watch list for quite a while. Unfortunately, I wasn't wise enough to pull the trigger right here at the lows set at the recent lows. This would not just this were. You would have to go back to 2015 or 16 to see the company back at 99 at the 99. Right, that was the price they were trading at, around $90 a share. That is staggering. Right? So look at all this wealth that was evaporated. So if you guys sold right here in the hole, right, you missed an incredible opportunity because you panicked. What happened right here was the thesis changed. Did the company all of a sudden become a shitty business, right? And the stock crashed from $343 a share all the way down to $90 a share? Or was it sentiment driven? Look, my take based on what I know today, right, in hindsight, it's definitely based on sentiment. And think about it. Can the value of a company change like 50-40% in a matter of 1 or 2 months? No, of course not. That is price related, not value driven. But okay, Let's talk about this then. As always, I always like to start with the financial statements, of course, right? Let's then talk about the income statement and see what we have. For those of you who are new viewers, I use stock analysis and also stock unlock to do my stock analysis. Uh, I don't pay for stock analysis, but I do pay a monthly subscription for a stock unlock, which you can see right here. And I like both. Okay, unfortunately, I still have to jump from one to the other, so I have to. I have to toggle between the two of them because they don't have. I don't see everything that I want in one place, which is quite annoying. But unfortunately, that's the reality. Right. Okay, so you can see that Stock and Log gives the company a very high score, right? 4 out of 5, which is very good right off the bat. It means that many of their criteria are, it means the company ranks high across many of their sections, namely profitability, management, growth, financial health, and dividends, and also analysts, right? So, yeah, look how constructive analysts are on this company going forward. We will touch upon that. But going then to the financials section, you can see in the income statement some of the things that I'm always paying attention to because that's what we want. Look, we want to see growing revenues. At the end of the day, we want to see that the company is selling more of its stuff. It can be a product or service. Are revenues going up? So you understand, typically, I like revenues to be growing at or above 10% per year over the very long term. Like think about 10 years, and I like to see 10-year, 5-year, and 3-year numbers, okay? But here, since 2019, you can see that revenue has compounded by about 20%. This is staggering, okay? Phenomenal. And look at the consistency of this revenue growth. That's pretty cool, exactly what I want to see. Look at the operating income, right? It took a beating right here in 2021. This was down. This was probably around the time, yes, it was. This was around the time that Meta was investing heavily into the metaverse. And that's exactly what spooked investors at the time. And they sold off the stock. And that's when Mark Zuckerberg pivoted right live. And he said, you know what? Let's let's be more conscious about how much we are spending on the metaverse, right? And so he pivoted, and since then, the cash, like everything within the company, just exploded. And I like Mark Zuckerberg. Is quite controversial. He's an outspoken leader, but I like how he thinks. And he has a lot of skin in the game, which we will touch upon as well. And so he's making decisions with a long-term mindset. And this is the kind of people you want to trust your money with. Okay. And sure enough, for example, I know many people watching this channel are already clients. And just like you expect me to have skin in the game. So if you invest in a company, right? Many of you will want me to be invested in the same company. And that's exactly what I do. So I share the portfolio. You guys see the positions that I'm in. I won't suggest a company if I'm not bullish on that company. As simple as that. And so likewise, I like to trust my money with management teams that show high integrity. Skin in the game is what really matters going forward, especially for long-term investors like us. Anyway, operating income growing at about 19% since 2019. This is fabulous. You can see that it's growing faster than revenue, isn't it? Just about the same. Very good. What about earnings? Look at that, about 18% per year. Look at, again, you can see this dip right here. The metaverse was costing the company profitability, but then they pivoted and voila, boom, we just exploded. And now, because of the investments in AI, that profitability is once again under pressure. So if I put this here, something happened right here, as you can see, in September 2025. Again, if you understand the company, you need to know I'm using the quarterly. So make sure you understand what caused this stumble in profitability in September 2025, and then a subsequent jump right here. But this, of course, on the trailing 12-month, what's this? On the trailing 12-month time frame, has caused some downward pressure, as you can see right here. Okay, but by overall, you can see 18% compounded since 2019. This is a very, very good income statement. I like that. In addition, I can also see what about the earnings per share? Look at that. So the earnings per share are growing a bit faster than earnings, which means the company is doing buybacks and they are certainly not diluting existing shareholders. I know that stock-based compensation at Meta is high, but what happens is the buybacks offset, right? Offset the share that any stock based compensation that the company is doing, and that's why earnings per share are growing faster than earnings. Okay, now let's discuss margins, which are very important. As you can see, gross margins have remained very stable. Look at the average, 81% going back to 19th, right now at 82%. Nothing to say about that. Moving on. Operating margin, again, it came down since that collapse, right? But then you can see that it's consistently upwarding, which is something that I like to see. The average is about 38. Right now we are at 41. This is very healthy. In the net margin, right? Look at that. The average 30%, latest 30, very consistent as well, even though we had this slump as we already discussed. But I like this, guys. Okay, I really do. And so what about the SG&A margins? Okay, so the company, look, the sales, general, and administrative expenses, which is an operating cost, has been coming down, which means that the company is prioritizing what? Efficiency. All right. So the company is trying, they are cutting down on some expenses in order to become more efficient. At least that's my understanding. That's why SG&A expenses are coming down, and while not sacrificing growth, because that's going to be important as well. But you can see that growth is going up consistently and at attractive rates, which is something that we like. Okay, now moving on to the balance sheet, what can we see? Look at assets again. We want assets to be going up. They are not just going up, they are flying. Look at this, 20% since 2008. Very good. Total cash. So total cash is going up as well, even against the backdrop of all the investments the company has been making. But that's the yearly. Do I see? Yeah, exactly. So, I mean, this is very healthy, guys. I mean, I like that. The company has a strong cash position. They will have no problems paying down any debt they might have. We will talk about that later on as well. But look at liabilities, right? Liabilities are also exploding. You can see that since 2018, liabilities have grown by about 41.3%, while total assets have grown by only 20%. Okay, this is not very good, because typically what we really like to see, ideally, okay, what we really like to see in the perfect world is assets growing at a faster pace than liabilities. But you can see that book value remains very healthy, right? When you do total assets minus liabilities, you can see that book value has been compounding by about 14.5%. Now listen, many of these companies don't have a lot of tangible assets, right? They have a lot of intangibles like intellectual property. And so is the book value really relevant? I mean, look, for a company like Meta, it probably isn't. And that's why if I go here to the balance sheet and I switch this to the trailing 12 months, you can see that for the market cap, so the market cap of Meta is around 1.64 trillion. But if you check the book value, right? So let's go here to the balance sheet trailing 12 months. You can see the book value. Where is the goddamn book value? Right here, 217 billion. Why do we have such a wide discrepancy? I mean, right? I mean, look at that. Because a lot of the market cap of Meta is linked to intangibles, and many of those intangibles are not on the balance sheet. So you have to understand these things. But anyway, I like to see what I have by and large right here. And so let's continue let's continue to the cash flow statement. You can see that cash from operating activities is growing at about 22%, staggering, very good. And so is the stock-based compensation. Right now, trailing 12 months sits at about 20 billion, and it's growing at about 25% per year. Do we have a lot of dilution? Let's check the metrics right here. Uh, pa- pa- yeah, I mean, I don't really like that. As you guys know, typically I like to see stock-based compensation under 10%, stock-based compensation in relation to operating cash flow. In the case of Meta, is almost at 20%. Look at that, right? But it has come down a bit since 2022, right? 23, a peak of 23, but it's still high though. But this is common among software among companies in the tech, in the same companies in the tech space. Okay, and share-based compensation as a percentage of revenue, it sits at currently at 4.56%. But yeah, I mean, ideally, I would like to see this and look at that. But we will talk about why the share-based compensation as a percentage of free cash flow currently sits at 44%. Okay, you can see this thing has actually gone up since recent lows in 2024. We will address this as well. And I think it has to do with the fact that the company has been doing CapEx, so investments that the company is doing in order to stay competitive in the AI space, right? So data center, a lot of these Max 7 are spending billions of dollars in new plants, property, and equipment, right? That is CapEx, and for sure that will deplete free cash flows over the short term, and which makes the share-based compensation as a percentage of the free cash flow to go up. Okay, let's discuss the cash flow. Continue on. So look at this is the cash from investing activities. Yeah, exactly. This is precisely what I thought. You can see that since 2024, right? Look at this jump, unbelievable. And this again, I can almost guarantee you this comes on the back of investments in CapEx. Okay, think about data centers. That's what all these companies are spending billions on. That's staggering. And what that does to free cash flow is it depletes, right? It gives you the impression that the company is cash flow, the free cash flow is going down. May give you the impression that this is structural, when in fact the company is using that free cash flow constructively to reinvest back into the company. What we don't want to see, I certainly don't want to see that, is maintenance CapEx. Think about a proxy for maintenance CapEx is depreciation and amortization. I don't like to see that maintenance CapEx take a bigger portion of total CapEx, because that would be a red flag, and it may be an indication that the company is actually operating in a less attractive industry. But all right, so we already discussed that, right? What else do I want to talk about? Let's have a look at the inside score right here. Profitability, I agree, 4.8, very profitable, as you can see. In fact, look at the cash conversion ratio. I tell you guys about the cash conversion ratio. I always use the cash conversion ratio for my analysis, because I want companies, as you can see right here, this is our proprietary intrinsic value calculation full model template that we use whenever analyzing each company. You can see that the cash, I always use that. Where is it? Cash conversion ratio. Here we go. I want to see ideally very high cash conversion ratios, because it means that the company has high quality earnings. So they are translating most of their profits into actual cash. And this is what I want. And sure enough, most of in fact, all of my investments have a cash conversion ratio above 100%. And that is certainly not an exception. And Meta is not an exception, as you can see right here at 150%. Okay. Okay. So management. I forgot how could I possibly forgot that? Let me talk about the returns on capital, because this is important. In a common theme that I see across all these Max 7 players is that the returns on capital are coming down, which is not good. And the reason for that is, again, because they are plowing billions of dollars into investments and they are not generating any returns on those investments. And what that does is it causes returns on invested capital to go down. Let's check if that is the case with Meta. Where do I see that? Ratios, yeah, okay. It is, right? So look at this. Okay, so look at Royce. Royce is at the lowest level, certainly since 2021. Look at this, 2021. Look at return on equity, also facing pressure as of recently, right? Look at Ross, also under pressure. But you can see that Royce, which is, in my opinion, the most important metric, is like just stumbling. Okay. Now, does that mean it's not attractive? No. I mean, come on. A 27.81% return on invested capital is attractive. For just to give you some context, I like to see Royce at or above 10% over time. That is certainly the case for Meta, but you can't but we have to be transparent and say that Royce has been under pressure, as you can see right here. But this again makes sense, and it remains to be seen whether those investments will yield any profits. And that is the key problem, guys. I wanna show you something that I was analyzing the other day, and I showed this to some of my clients. I mean, take a look at this. Let me see. Look at this. Okay, why is this taking so long? Come on. Yes. So take a look at the CapEx as a percentage of cash flow from operations, right? And what happens is these are the hyperscalers. Think about companies like Meta, Amazon, Microsoft, and you can see that CapEx as a percentage of cash flow from operations, it is at one of the highest levels ever. However, if we look at these companies' valuations, they haven't come down enough. So these companies are spending so much money. They are like oil companies, right? They have so very high capex. We are not seeing returns on those investments yet, and valuations haven't compressed enough. So, I mean, will this set the markets up for more volatility going forward? Maybe. Okay, it's something you need to pay attention to. Right. So let's talk about other things. Let's have a look at the financial position of the company. We've already touched upon that. The current ratio is 2.60. Okay. The debt to free cash flow, even though the company is doing a lot of investments, you can see that it will take the company less than 2 years to cover all of its debt from current free cash flows, which is very good. So nothing problematic here. In addition, interest coverage ratio of 71. It means the company can easily cover the interest payments on the debt from its operating income. That's okay. They have a negative net cash position. This wasn't always the case. But what I really like is, look at this. They can pay down all of their total debt with cash and cash equivalents, so just off the balance sheet. And this is something very, very good. It's very, very positive, which means that Meta won't face any problems from a financial standpoint going forward. The shareholder yield sits at 1.87%, which is not attractive if you ask me. Likewise, the earnings yield 3.6%. Free cash flow yield, don't read too much into this because free cash flow is down, as we already discussed why. But the earnings yield at 3.6%. I mean, look, is this attractive? It doesn't really excite me. But let's have a look at this company valuation now. So purely from a fundamental standpoint, I look, Meta is a phenomenal company. And again, we are talking about an owner operator. And if I show you this right here, if I go to the ownership tab, show only company executives, you can see that the CTO has about $1.61 billion worth of stock, which is a lot. Yeah. You can see that Mark Zuckerberg, this is incorrect. Is this correct? This can't be right. Wait. Mark Zuckerberg is right here. He has $17 million worth of stock. I think this is too low. I'm not sure this is accurate. I know he's been selling a ton, right? If I go to insider transactions, I mean, look what the insiders have been doing over the last several months, right? Look at this wave of selling, 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 selling. Look at this. Take a look at this. February 2026. Look at these cowboys. I don't like to see that. Oh my God, I don't like to see that one bit. Now, look, there are many reasons why insiders might sell, but when you see executives selling like this is not what you want to see. All right. And so, uh, yeah, I mean, take that as you want, but I don't like to see that. What it tells you, right? Look at the insiders, look at this wave of red. What it tells you is that insiders may think the stock is expensive, which is why they were selling it a lot. But anyway, I thought Mark Zuckerberg's stake in the company was actually higher than the one that we are seeing right here. I'm not sure how accurate this is. But anyway, you can see that many insiders own several million of dollars worth of stock, which is very good. Now, I don't like the fact that they are selling, as I already alluded to. So yeah, just take that into account. And then what we have, you see the companies trading at the PE of 27.65. Is the PE the accurate method for a company like Meta? Well, I mean, it is right, because if you look at earnings, you can see that so this was obviously what happened in 2021, but you can see that the earnings typically tend to go up, and you won't find, maybe if you try or other metrics, but I think net income works well with Meta. Okay, if you look at the operating income, that happened as well, but it's less bumpy. But I would use net income. And so, yes, I understand the PE currently sits at about 27.65 times, which is not cheap by any stretch of the imagination. The forward PE is more attractive at 21.46, but in my opinion, it's still, I can see that analysts are, of course, they are always bullish on this company, so they have a strong buy rating on the company. But guys, if you are following the channel for a while, you know that I want to double my money every 3 to 4 years, and that means at least a 15%. At least, well, I always want to achieve a 15% return on my investments over the very long term. Okay, and so will Meta double my money in the next 3 to 4 years from current levels? I don't think it will. And let's be realistic. The company now has a market cap of about 1.64 trillion. Okay, and you can see that for us to double our money, let me do a quick math here. I've shown you this many times. Let's do quick math. For me to double my money, the stock price would have to be at about 1,299. Let's call it $1,300 a share. Okay, assuming in 5 years the company would have a PE of 20. Okay, so what should be the growth rate of the earnings per share? That's what I'm trying to identify here. So let's do the math. 1.20. So this divided by the PE of a PE of 20. This gives you about 64.99. Let's call it 65. Current earnings sit at about 23.49. So what we will do is you come here, go to the compounded annual growth calculator, calculate future value. Okay, you have this here. What's the 23.46, right? 23.46. What am I doing? No, it's this, sorry. Okay, 23 point this. And now 64.99, 64 2.99. And in 5 years, this means earnings, right? Earnings would have to grow at about, come on, it's taking a while. Apologies. You can see that earnings would have to grow at about 22.57%. In what we know, if we go back, we can see, let's see what analysts are projecting going forward. And if I go here, you can see that analysts are projecting about, look at that, 19.17% growth going forward, and they are usually optimistic. Look, the question you have to make then is, do you think Meta can grow earnings per share by about 22.57% over the next 5 years? And if you believe that is going to be the case, then you will have a double. I'm more conservative, as you guys know, and to me, means that Meta is not an attractive investment at current levels. And so I'm certainly not pulling the trigger on this company at this time. Okay. Uh, Again, not financial advice. I'm not here to do that. Everything we do on this channel is for educational purposes. But this is my position. Okay. And sure enough, if I go here, for example, to our intrinsic value calculator, let me do the math right here for you. So what's the current stock price? 650. Let's change that, 650. What is the number of shares outstanding? Shares outstanding, let's go here, trailing 12 months. Number of shares outstanding, we have about 2574. That's the number we have here, 2574. Assume 3% perpetuity growth rate. That's about the growth of the economy. As always, I want 15% or a 15% return on my money. That is my discount rate. What is the free cash flow in year one? For Meta, I will use net income, right? That's the metric that we are using. And if we do that, you can see that net income currently sits, where is net income? Right here, right here. So we have 6458. Okay, 6458. Now, I never go beyond 15% growth. That is my threshold for conservative reasons. And if we compound our free cash flows, right, so our net income by about 15%, this is wrong. Hold on, this is incorrect. Yes, I already know what happened. Okay, that's exactly so. For that, plus 15%. Oops, what happened? Of course. Let me do it here again. So I want to see this times 1 plus, then I want 15%. Okay, now it's working okay. So this is free cash flow in year one, right? As you can see right here, this is in year zero. And so if we do that, we can see that the intrinsic value per share would be around 436. And right now, the stock is currently trading at 649. So what that means now, if we reverse things, is let's move the cash flow up to 20%, and you can see that the the growth implied in the stock price is around 21% per year, isn't it? Look, 649 exactly. So the stock is currently pricing Meta as though its free cash flows will grow at about 21% per year over the next 10 years. In my opinion, this is too optimistic, and for that reason, I'm not interested. Call me when this thing moves down to about 436, and I might be more interested. Okay? Everybody, As always, thank you so much for being very valuable members. And smash the like button if you enjoy this video, and if you want me to create more content like this, let me know in the comments what you would like to see going forward. Don't forget our upcoming group call on Saturday. I'm looking forward to seeing you and to meeting you. So stay tuned for more, everyone.